Hi everyone, hope you're doing well. Today I'm going to do the UK stocks I'm buying February 2025 edition. So this is where I go through all the UK stocks that I bought and sold between the 1st of January to the 1st of February. I've done this as a monthly series on the YouTube channel for many years now, and it just keeps up that transparency so you get to see every move that I've made. If it's a stock that's done well, you will see it. And also, what sometimes the other stock market YouTubers don't show you is the stocks that don't work out, you'll also see them as well. Everything I'm buying is for a long-term hold, so I'm kind of looking for that 2 to 5 year period, but sometimes it can work out a little bit better than that in the shorter term, so just bear that in mind. Apart from that, I hope you enjoyed the video, hit the like button, let's get started. Now, just before we do start, I just wanted to shout out, I am going to do a sale just across this weekend. Friday to Sunday, you can get access to the Discord, a Valentine's sale. I thought, you know what, we've had such a good year last year. This year has already been such a good year. We were up double digits % return already this year. Hims and hers is flying. I wanted to kind of share the love with you guys and do a Valentine's sale just for this weekend and just say thank you for the last few years, and hopefully a little bit of a celebration for what has been a fantastic few years for me in the stock market, hopefully for you in the stock market and the YouTube channel as well, because we have been smashing it. So yeah, I'm going to do a Valentine's sale just across this weekend. £50 for the full year. You get access to the Discord. The Discord is exactly the same as Patreon. You just don't get the emails through when I post things, but you will get the notifications through the Discord. You get access to 100 exclusive videos over the next year. You get to know what I'm buying and selling in real time, and you see the exclusive content like the UK portfolio review that I've just dropped for February 2025. I'll post a link in the description and in the comment of the video. You just have to send me an email, jkinvesting@gmail.com, and I'll get you on board. But like I said, it does run out on Sunday night. I'm only doing a quick sale just to say thank you for the last few years and the start of this year as well, so do go join that. Now I'm just going to talk for a minute or two and just ramble on for a second. I hope you don't mind. If you do mind, then skip about 1 or 2 minutes and I'll get into my stock picks. But I just wanted to address the elephant in the room, because I did this video obviously last time in January, and you can see here the 6 UK stocks I'm buying January 2025. And on that video, I gotta say, there was a common theme out there. There was a lot of negativity to UK stocks. There was this comment, for example, I could have copied and pasted loads of comments, but people saying, why buy UK stocks? The economy is shrinking, there's no point investing in this space. And that is true. Obviously, the UK outlook isn't good at the moment. That is why the UK Bank of England have just halved the UK growth forecast. That's why the interest rates are having to come down. We have a government in power at the moment that is very anti-growth. So why invest into the UK economy? Well, the thing is not we're not investing into the UK economy. We're investing into the stock market, businesses. The stock market is not the economy is not the stock market, and that means there's opportunities to be made in the stock market. You are not investing in that economy. You've got to remember, some of these businesses aren't just UK businesses. They might be listed on the UK stock market. A bunch of these companies might actually get their revenue worldwide from different countries. So don't just make that assumption of that I'm not buying a UK stock because the UK economy is bad. You might end up missing some opportunities out there. And for example, if you were to look at my best 5 performing stocks in 2024, 3 of my 5 best performing stocks were UK stocks. So if you had that attitude to UK stocks, I would have personally had not as good of a year as what I did. Dark Trace ended up being 100% return for me, and that was a company that had the majority of its revenue come from outside the UK, did really well for us. Watches Switzerland Group, once again a UK stock that did very well for us. We walked away with a very good return from Watches Switzerland Group, buying in this dip and turning around. Once again, a company that mostly gets a lot of its revenue from outside the UK. And even in the UK, you can sometimes get some stocks at good valuations. Supreme was one of those stocks that we bought and was one of my best performing stocks, and that does have a lot of its revenue from its UK, but it just got to attractive valuations, and that is what it is to be a stock picker. It is to find good valuations for good companies, not to be staring at the UK economy. And as well as that, there's some stocks out there that are now getting unbelievable dividend yields as well with the negativity, and sooner or later they will come back into trend. So there is opportunity, and I do believe there's money to be out there. Even though, yes, the UK economy might not be great, there's still plenty of opportunities out there because the stock market is not the economy. So let's get on to number one. Number one, Gaming Realms, a company that is getting a lot of its growth from outside of the UK, funny enough. Gaming Realms is a stock that I have had for the last kind of couple of months. I cannot believe the share price has been this stagnant for this company. The only thing I have got around Gaming Realms is that I already have a lot of exposure into Gaming Realms in the space it operates. But I've kind of got to the point of view now where I look at the valuation and the growth and I go, you know what? I'm just going to have to buy it here, and it is coming a large position in the portfolio. I cannot believe the stock has stayed so stagnant after the financials that it has been posting. Now, in case you don't know what Gaming Realms do, they provide some of these games, mostly the Slingo games here, and they do different variations of the games, as you can see here. The Slingo game has been very popular and is used by a lot of the major brands out there like BetMGM, DraftKings, Entain, Flutter, and these brands are using the Slingo brand and also being able to use different variations of these Slingo brands, like we said. Now, what is happening at the moment is the iGaming growth is great. So these companies here at the moment are so focused on doing their odds and trying to scale up the platform in different countries, they don't actually operate the game. So they get someone like a Gaming Realms Slingo game, put it on the website, and then Gaming Realms take the cut. So it's a bit more of a kind of picks and shovel play at the moment. Now, if you look at the growth rate of iGaming is actually going bonkers at the moment. A lot of that is to do with the US growth. We've covered it before on the YouTube channel. They've only just started to allow iGaming. I think there's 5 or 6 states at the moment, and potential for big expansion at the moment. If we look at 2023, the CAGR of this space was 18.92%, and potentially we could see the expansion go to 125 billion by 2027, or even 583 billion by 2030. It would depend on the other states that come online. But what will happen is, as states come online and more of these brands use the Slingo games, they're going to take more amount of revenue, and they keep signing more and more clients. They actually did come out with their pre-trading close on the 4th of February. And looking at the numbers, they were once again fantastic. If you look at revenue, it was up 22%. EBITDA grew at 30% as well. This is all while the company is currently trading at a forward P of 11 times earnings. You should not be picking a company at 11 forward times earnings that is growing 22%, that is a tech company. And it's also got most of its revenue outside of the UK as well. This should not happen. There's a big disconnect here. I would say that this should be at least 20 times earnings. So in my opinion, it is majorly undervalued right now. And we can see the execution as well. Previously, it's had fantastic revenue growth. It has had fantastic profit growth, and that's only forecast to continue. Balance sheet wise as well, it's got a cracking balance sheet. There's no debt on the balance sheet. It's got a nice healthy cash balance of around about 10 million. That's 10% of the market cap, and like we said, it's a pretty healthy, profitable company. So this is also going to be throwing off a good 7-8 million a year that they can also do things with this cash balance. That would be my only criticism of them, is it's time to start using that cash to maybe pay dividend, do share buybacks, take advantage of this cheap share price right now. But right now, I can look at Gaming Realms and say right now this stock is probably undervalued by, it should be double the share price. And then if you start putting in the future growth of iGaming coming in, it could even be higher than that. So I would say there's even 100% upside to even more than that in the next 5 years. And I really like Gaming Realms, and the fact that they just brought out this trading update, and yet the share price, it has started to bounce up in the last kind of couple of days since I did buy, to be fair to it. If we just go in the last 5 days, it is up around 13%, so it is starting to have a little bit of a bounce now. But originally, when this stock did bring out these earnings, it just didn't move, and I was like, okay, this should have been up today a lot. I posted on the Discord, I was like, this should have been up like at least 10% today, and I was buying I was buying through the month of January, and I also bought when it didn't move off those earnings because they were absolutely fantastic. That's coming into my number one position in the portfolio. Now, moving on to number two, which is also coming, I would say, my second largest position in the portfolio, is another company that gets a majority of its revenue and profit outside of the UK, which you probably won't realise because we associate JD Sports as being a UK brand, but they are very much in Europe, they are very much in the US, which is actually where a lot of their growth does kind of come from. They do pay a bit of a small dividend here, but in the last year, the stock has been absolutely destroyed. It is now at lower levels than the Liz Truss time, which is crazy, and it's now getting to the same levels as it was in the peak fear of COVID. The time when all of its shops had to shut, the stock price has now gone lower than that, which just does not make sense for a business like this. Now, JD Sports, they've got the online business, they've got the UK brand, but also what people don't realise is they have the US and European brands, and they are expanding massively, and they are major reasons of why the growth has been very good for the business in the last few years. Now, you would think that the results have been awful in this business when you look at the share price, but it's not. There's been a little bit of a downgrade on the profit by, I think it was 3%. A 3% profit downgrade should not turn into the share price being down 50% in the last 5 years. That just doesn't make sense with this business. And if we do look at the recent earnings, revenue growth of 3.4% as well. They are not joining in the promotional environment. So if we do have a look at the gross margins are actually holding up pretty strong at the moment. And at the moment, before tax, before profit, it's expected to be around about 950 million to 935 million. If you start looking at on a market cap point of view, this is a 4.3 billion market cap. There's just a major disconnect going on with the share price and the numbers that they're actually doing. And if we do look at a context of how well this company has executed in the last few years, especially like we said, since the COVID times, the revenue has exploded with that European and US growth, and the profit is really ramping up as well. You get a balance sheet that is also very strong. There's a little bit of debt on there, but I believe in the latest earnings they've actually paid that debt off as well, which is great to see, and also a good cash balance. And obviously as well, when you are making what the forecast is 643 million going into next year, 643 million on a 4.4 billion market cap is ridiculous. And as well as that, with 643 million, you've got the options to do a lot of things like buybacks, for example. And if we look right now, that puts it down to a 6 times forward earnings. We shouldn't be getting a retailer of this quality at 6 times forward earnings. You would at least probably assume like a 12 times earnings. I would argue the case you could be higher. So I would say once again, we're looking at a company right now that I think is probably should be double the share price, and you're not factoring any kind of growth here. And you look at the numbers that JD Sports have just done, and you go to other retailers like Foot Locker. At the moment, they are struggling massively on the profitability front. Revenue is declining 1.5%. Major brands like Nike during this time period, their revenue is down 7.8%. But yet, JD Sports are still dragging out good growth in the revenue, good profitability numbers. So this is one of the best brands right now doing good financials when basically everyone else is struggling in this space. So I like this one massively at the moment. Next one is CVS Group. So this has had a good month actually. I probably won't buy any more of this stock unless it drops from here. So I am up on this position since I have started buying. So I'll just make you aware of that situation right now. So what they do is they do veterinary services. They don't do this under like Pets at Home. They do it under different brands. And that is a pretty growing CAGR at the moment. We've seen a big explosion in pets, especially after the COVID times, and a lot of them COVID pets as well. They're starting to get towards, the 4-5 year old as well, and obviously they're starting to age as these pets age. Obviously that normally equals pretty higher veterinary services or bills. And what we're seeing at the moment is the plan is to grow between 4 to 8%. They are expecting margin expansion going forward. And as well as that, they are expanding into other areas like the Australian market, which they feel like they could take good market share from, and also is a very similar market to kind of the UK market where they've had very good success from. This used to be a stock in the UK markets where it used to be a diamond of the stock market. People used to love CVS Group, but as you can see here in the last few years, they've kind of fallen out of love with it. So if they can get this UK market back in good directions and also this Australian growth as well, it will be very good for the business. And historically, they've got a good track record of growing the revenue and the EBITDA as well. Veterinary services is the biggest biggest part of the company, and probably the reason why the share price is so low is because at the moment there is a CMA investigation hanging over the business. So they are looking at the moment and saying, is there kind of a monopoly going on? There's kind of 5 players that control the veterinary service in the UK, and that report is going to come out in November. Probably by that time there'll be a lot more clarity, and potentially that's when the stock might start moving up in the right direction when that does happen. Now, when we do look at the CMA at the moment, there is a little bit of a slap on the hands going on there. They seem to be like going, you are getting a bit too taking it too serious. You're starting to crush the growth a little bit at the moment. So that's also a positive for CVS Group, that maybe the CMA may go a little bit lighter on this report. I don't think they'll be too affected at the moment, and when you look at the share price and how low it is now, I think a lot of that fear is kind of baked into the stock. And if the company can go back to the normal growth that it has done, profitability starts coming back as well. I think this is currently around about 10 times forward earnings, and we see strong growth from the Australian market. This could actually be a very good player going forward. That leads me on to stock number 4, which is B&M. Once again, this is a stock that has had a tough time at the moment. It's kind of at the levels it was during that Liz Truss period, which obviously shows you the amount of fear that it was at. And it's also near the levels as where it was during that COVID dip when it had to shut all its stores. So once again, yeah, maybe a bit too low for B&M. 9 times earnings, a 4.7% dividend yield, so you do get a nice dividend for holding it. They do historically as well play a bit of a special dividend, and sometimes that does put the dividend yield up to like 8-9%, which is also really nice as well. B&M in the UK markets, I'm probably sure you've seen the B&Ms on the high street as well. Obviously there's quite a few in the UK at the moment. The recent earnings were pretty good. UK was okay growth, maybe want it a little bit stronger. The B&M France, which is their expansion into a new country, is doing very well, and the really only weak bit was Heron Foods, and hopefully they can sort that situation out, but that doesn't make up a good chunk of the revenue, so that is okay. Their plan at the moment is they've got 764 B&M UK stores. The plan is to nearly double the store print in the UK, and as well as that, B&M France has a lot of potential for them. As we've seen, it's been a very strong area for them, and if they can obviously expand those stores up to where they're at the moment, 129 stores, and start pushing that up to 200, 300 stores, that's probably going to be the big growth driver for B&M in the next kind of few years. And this company has historically executed very well with expansion. If we do look at the previous numbers, the revenue growth has been very strong, and the profit growth has been very strong as well. From where we were at COVID times, 3.8 billion in revenue, we're now up to 5.5 billion in revenue. From a profitability point of view, we're at about 203 million. We're now at 326 million as well, so it's massively improved. And as well as that, historically it's had pretty good profit margins. 6% profit margins for a retailer is very good, especially when you compare it to the other retailers like Tesco, which historically sits at a 1 to 2% profit margin. A lot of other retailers as well normally trade at like a 14, 15 times earnings, where when you look at B&M at the moment, at a forward P, it's currently down at 8 times forward P, and B&M itself historically does trade a lot higher, which is another positive for B&M. Ownership wise as well, there has been a little bit of buy-in with the lead director coming in and buying some shares as well, which is great. So yeah, with B&M, a little bit different from the other ones because it is a good valuation, but also I feel like if you just sit on this stock as well, you're getting a really nice dividend to collect, which is great with B&M. Moving on to stock number 5, which is Card Factory. So I have been buying a little bit of Card Factory during the month of January. I personally thought the stock should be a lot higher at the moment than where it is right now. 8 times earnings on a forward P, I think it's something like a 6 times forward earnings. And once again, this is what I said about the UK markets. There's some really nice dividends out there. You're getting a 6% dividend for just holding this stock, and there's also a lot of potential for them to kind of hike this dividend up as well. So the stock fell rapidly during this time frame because the market freaked out because they wouldn't be able to hit the full year numbers, and well, it's turned out they have hit the full year numbers. So in my opinion, why has the stock not gone back up? We do not know. We'll look at that a little bit later in a second. Card Factory, obviously the high street retailer of cards. People still like to send cards, and also they want to get it a little bit cheaper than some other places that charge £4 or £5 for a card. Obviously at Card Factory you can get a card for £1-2. And the other key thing about Card Factory is its partnerships. It's been signing a lot of partnerships, like becoming the exclusive card supplier for Aldi, and expanding into other countries as well, through like Australia, New Zealand, through the Reject store as well. So it's been making a lot of good partnerships as well, which has been great for them. This has mean that they have been able to hit their full year guide from these partnerships, and other things as well, like price increasing, selling more expensive items like the gifts range. And you can see here on their update on the 14th of January, they hit their full year guide. Their revenue increased by 6.2%. Like-for-like stores was up 3.9%. Partnerships revenue that we just talked about was up 23%, and profit was in line with the guidance as well. So all the numbers hit, but yet the fear that they wouldn't hit the numbers sent the stock down here, but now they've hit the full year numbers, the stock still hasn't rallied, which just doesn't make sense. And under the new leadership that they have under Darcy Wilson, I think that this will only continue to do well as the revenue comes in from these partnerships, and we also see the profits start scaling up as well from these partnerships over the next few years, and we see the stock start rallying up more and more. Balance sheet wise, it's not the mess that it used to be. This balance sheet was awful before COVID, and COVID helped them really, because they didn't have to keep paying a dividend that was too expensive for them, and they were able to pay a ton of that debt down, as you can see here. They also can then go make acquisitions, which they have done. They made an acquisition into the US market, so looking to expand there. And as well as that, just to fill you up with a little bit more confidence, look at the insider list of buys that are currently going on the share price drop at the moment. You've got Darcy Wilson there buying at 50k worth of shares, and you've got I believe it's the CFO, the CFO buying some shares as well, lead director buying some shares as well. It's great to see at the moment. So I think this is going to go towards 6 times forward earnings. A quality high street retailer like this, in my opinion, you should be talking about 12 times earnings, and as well, you got the lovely dividend that you've got going on over there as well. Next one, Audioboom. So I did buy a couple of shares in Audioboom as it had a little bit of a dip recently. Since then it has bounced up, so this has been a very good performer for us. I'm up around about 30%, so I probably won't buy any more shares in this one unless it has a crazy drop, so I'll just make you aware of that one as well. Audioboom, what it does is it gets creators of audio content. They then put it out to the audience through Spotify, YouTube, for example, and then also connects with advertisers, and they are able to put adverts onto the platform for these guys and then take the commission for it. This is a big growing space at the moment. They think there's going to be an industry CAGR of 22%. And that will put them onto very serious amounts of revenue in the next few years if they're able to keep up with the industry. This company used to be a lot higher than where it is right now. 2022, look at the share price. Had a big massive crash, but it is starting to rebound now, as you can see here. A lot of things went wrong for them during that time period. Basically, Apple made some changes to the download, so the podcasts weren't automatically downloaded onto your phone. We had an advertising recession during 2022, and obviously people all going back to work during 2021 as well, which also hit the downloads. All that is out the way now because the Apple changes have all been priced in. The advertising market has rebounded, and also we've got over the kind of COVID numbers going back to work, and now we are starting to go back up to growth. And what they've also done is they have invented a new platform. So they have a new platform for their content creators to use, which is Showcase. It's starting to come up more of their revenue that they are currently using, as you can see here, but also the gross margins on this product is a lot higher than the ones they've historically done. The reason why is it's able to link up their advertisers to their creators a lot better, and also so the advert suits them a lot more, and also it creates the adverts very quickly for them as well. So this is making them more and more profit, and what we're starting to see here is a boom in the profitability of the Audioboom from the Showcase platform, and as well as that, this is growing very fast as well because of the efficiencies they're getting as well. So we're seeing the Showcase platform growing 56% year over year, which is great. What we've seen now is major upgrades from the forecast, so we can see the revenue growth starting to come in. The net profit is starting to really bounce back now after the advertising recession, the Apple downloads. They also had a couple of bad contracts that are coming out of the system as well, and the profit is starting to seriously ramp on the business. We are looking at the company on 2025 numbers being around about 14 times earnings. This is with a 10% growth though. I think they're going to be somewhere between 15 to 20% growth. So at 15 to 20% growth at 14 times forward earnings, yeah, this looks attractive to me, and I think there'll be a few more broker upgrades coming for this one as well when they do realise the numbers that are going to come out of this business. Next one, Barrett Redrow. So I just extended my position into the house builders because I think they will rebound at some point. I also used some money from a position I sold in the construction space and put it in here, and that is also the reason why I did buy. We are short of houses in the UK, and the only way we're going to get more houses is by the government supporting some of these UK house builders, so I'm kind of hoping that is going to happen. As well as that, we are finally starting to see the interest rate cuts starting to come in because of the weaker economy out there, and hopefully that also gets the housing market going up a little bit more. Obviously there'll be a lot of people at the moment that have been put off buying houses because of these interest rate cuts, and what we have is probably a pent up demand, and as that demand sees those interest rate cuts coming in, I'm sure they'll start coming in and buying some of these new houses. And the last one on the list was Warpaint. So I did start buying before the drop. I'll make you aware of that one. So this has been a little bit unfortunate. Obviously I've shown you guys today a lot of stocks that have been rallying after been buying them, like Gaming Realms, for example, the likes of CVS Group, the likes of Audioboom, for example. But for this one, unfortunately, I've been whacked a little bit after I bought this one. So it is down a little bit after the update that they brought out this week. They brought an update out which was actually in line. The revenue was below expectations, but the profit was in line, and they did sound very upbeat. Strong performance for the year, yeah, it's been a bit of a strange move from Warpaint. What I'm going to do is I'm not going to cover it on today's video because this is a stocks I'm buying, not a review of Warpaint's earnings. So I'll kind of give more thoughts on that on the Patreon for you guys over the weekend. And obviously, if you do want to take the sale to get on there onto the private group through the Discord, obviously you can probably get that Warpaint video, but I won't talk about that one a little bit too much today. And that is, like I said, the last one, and that takes me on to the stocks that I did sell over the last month. And there was a couple of stocks that I did sell on the UK market. One stock I sold completely, and the other ones I kind of locked in some profit. So the first one, Supreme, one of my best performers in 2024. I did decide to lock in some profit on Supreme. I took a 10% trim of the position, and it was for a 70% of the 70% gain, which was really nice for Supreme. So a little bit of profit taking on there. I did go on the UK portfolio today. I did go into a little bit more reason on why I am taking the profit there. Eurocell was the one that I sold completely out of. I just moved that into Barrett Developments, Barrett Redrow, should I say now. I decided to just take the profit from Eurocell and put it into that building business. The reason why is it just sounded very, they brought a trading update out. It just sounded really negative. They said that they're going to have to increase prices, but in the same trading update, they said that they are seeing competitive pressure on selling prices. Well, the last thing you want to be doing is putting up prices if you're seeing competition. That is not going to work. And I thought I'm going to move away from here and just put it into a Barrett Developments that maybe is not, maybe not suffer from the likes of the NI costs as well, maybe competition, and also probably get more government support going forward as well. So I decided to sell that one out. I took a 5% gain. Maybe should have been a bit quicker on the sell button because I could have got a little bit higher of a return there, but it is what it is. And the last one was Airtel Africa. I decided to lock some profit in Airtel Africa because it has run up a lot in the last couple of weeks, and I locked in a 5% of my position for a 42% gain. With the dividends on top, that's probably more towards a 60%. So yeah, being another really good winner for us. I just thought, you know what, I've had to sit on my hands on this one for a few years. I've now got the rewards. I'm going to take a little bit of profit off the table. I'm not sure what I'm going to do with the rest of the position now that we've kind of passed that FX impact. There's part of me thinking there's still upside here. There's part of me thinking, you know what, you've sat on your hands for a couple of years. You know, this is the thing. Sometimes you've got to have patience with these stocks, and then boom, you start getting your rewards. But there's part of me thinking as well, you know, just take the rewards now and move on and go for something else. I'm not 100% sure, so while I wait, I thought I'd lock in a little bit of profit. And you know, a lot of people gave up on this stock over the last kind of couple of years, but if you're stuck with it, you're getting the rewards now, and that's the key thing with this long-term gain and being a long-term investor. There's some time periods where you just have to wait a little bit to get your rewards, and that's happened with South Africa, and we're finally getting the rewards there. And I'm sure that'll be the same for the likes of JD Sports, Gaming Realms, for example, B&M. You've just got to sit on your hands for the next kind of little bit, and eventually, you know, out of nowhere, you get the rewards very quickly, and you know, it can come out of nowhere as well. So yeah, overall that's everything. So that is the UK stocks I'm buying, and also obviously as well the UK stocks that I sold. I'm not going to make another video on the YouTube channel this weekend, so the next time I'll see you is on Monday, unless you are on the Patreon, and obviously you can get on there, and the Discord on the private group. Obviously you can get on there over the weekend. We're going to cover some UK earnings, we're going to cover some US earnings, and I'm also going to try doing my US portfolio review for you guys as well over the weekend. So obviously there should be about 4 exclusive videos on there this week. So yeah, if you do want to join, take advantage of the sale and before it's over on Sunday night. Thanks for watching, guys. Have a great weekend. See you in a bit.